Good morning, it's Jeff Christian of CPM Group. It's about 10:45 on Tuesday, the 31st of May here in New York. Thought I'd talk today about a precious metals market update, where we see prices now, where we see them going, and why. We've seen gold and silver prices consolidating in this range, a little bit of weakness over the last few weeks. We were definitely surprised. We thought that the prices would show a little bit more strength than they have, but they are in this range that we've been talking about for a while. Going forward, our expectation is that gold prices will move slightly lower to sideways over the next few months. We are looking for a summer consolidation, weaker inflation figures coming out, higher interest rates, seasonality, reducing demand from both fabricators and investors for a time. We do see the gold price, possibly piercing 1,800 and dropping as low as 1,780, maybe even 1,750, depending on how the economic environment shakes out. Silver, we have a slightly more bearish view, although the price is sort of where we were thinking it would be over the summer. We had been thinking that the silver price could go down and trade around $22 an ounce during the summer months. It's there. And our question is, does it go even lower over the next few months, or does it sort of consolidate around this level? We're not certain. We do see continued concerns on the part of mainstream investors that the silver price had sort of been overblown for a while, and now it's come off. Premiums are looking a little bit more attractive, so that should help some investment demand. Again, longer term, we do think that these prices will move higher because we see a worse state of the world. We want to talk a little bit about platinum and palladium because we tend to not pay attention to them in the videos. We pay a lot of attention to them in our research and our consulting services because it's very important to companies that are involved either in producing or processing or investing or using precious platinum group metals. But the videos, I think we tend to assume people are more interested in gold and silver than platinum and palladium because gold and silver are really much more financial assets as opposed to industrial commodities, and we assume the people watching the videos are more investment oriented as opposed to commercially oriented people. That's probably a bad assumption because we have a lot of commercial clients and contacts around the world who tell us that they watch these videos regularly. And I will say, well, I'll say that later. So platinum prices and palladium prices have come down. Our expectation had been that platinum prices would come down to about where they are now. They're about $960, $950 an ounce, I think, right now. Our expectation has been that they will probably stay relatively weak during the rest of the second half of 2022, and then show some strength beginning in 2023 and going forward. One of the big issues is a general weakness in commodities because of pessimism about the state of the economy. And another one is continued weakness in auto sales and auto production because of supply constraints, not only on semiconductor chips, but on other components. And also there's a hesitancy to buy large ticket items like new vehicles when you are concerned about the imminent arrival of a recession. So that's putting a limit on the price of platinum. Longer term, we do think that platinum has some positives that will probably take the price higher, but we're waiting to see what that happens. Palladium prices, we expected to be a little bit stronger than they are. We wouldn't be surprised to see the price recover back up to maybe 2,300, maybe even 2,400 over the course of the second half of this year. Part of that has to do with the war premium in Russia, and that may be dissipating somewhat. Part of it has to do with the continued bumping along of the auto industry. It remains to be seen. So we're still looking for palladium prices to show a little bit more strength than they have been in the last few months, the last month or so. Now, trying to guess the future price trends for any commodity or any asset is difficult. You need to look at the world around you. And we've written extensively for 50 years that if you really want to understand what's driving investment demand, you have to look at the economic and political environment. And that's true. And it's also true for industrial commodities such as oil, which is now back up around $118 and showing a tremendous amount of strength, partly because of the ongoing war in Russia's invasion of the Ukraine, and the European Union ever so slowly saying, well, maybe we should reduce our oil imports from Russia. And there was a partial agreement that was pretty weak that came out Monday in the EU. But let's start with the economic environment. You're seeing slower growth. It was expected. It's slower than it had been expected in the United States, Europe, China, and other parts of the world. Part of that is the war. We have seen economic projections of real GDP growth downgraded and reduced by the IMF, the World Bank, and other independent organizations, as well as private sector banks and brokerage house economics departments. We have been expecting slower growth. Growth is slower than we had thought. Obviously, the war and Russia's invasion of Ukraine has something to do with that, but there are a lot of other factors there too. There is a tremendous amount of uncertainty about when and how deep and how long the next recession may be. And there are people who say that we're already in a recession. There are other people who say we're headed that way and we could fall into one in 2023. I think that, we have been saying 2024, 2026. It could happen anytime, but that uncertainty is very important. And it is, in fact, one of the factors that's helping to support gold and silver prices where they are. And it's very funny because, again, the gold bugs keep saying, hey, gold should be $10,000 an ounce here. But the reality is that gold prices are kind of like at record levels. And silver prices are pretty high too. So you're seeing that uncertainty helps support gold and silver as safe havens, alternative assets, portfolio diversifiers, currency hedge, inflation hedge, etc. There are a lot of mixed signals in the economy, both in the United States and on a global basis and in other countries and regions. You're seeing the slower growth. You're seeing some slack sectors of the economy that suggest that the growth can continue for some period of time. There are other sectors that have been very tight: housing, autos, oil and gas, food, and some of those sectors remain very tight, but we're seeing some slackening of tightness in some areas. One example is housing. You're seeing higher prices on home sales, but on sharply lower volumes. If you look at US housing sales, the most recent data, probably from April, was 14% lower than it was in January. There were 14% fewer new home sales in April than there had been in January. The average price being paid has continued to rise. You have fewer homes being bought, but those that are being bought are higher priced. And that's not unusual in this kind of economic environment. We've seen it in the past. You'll see lower volumes of houses that have lower prices being sold because of the economic strictures on that portion of the economy that focuses on that lower priced housing. And there are a lot of economic strictures on that sector of the housing. But then wealthier people will continue to buy new homes or buy old homes newly, and they will pay higher prices. So you've seen this in the past. You saw it during the run-up to the Great Recession and the global financial crisis, where the average price paid for houses will rise strongly, partly because housing prices are rising, but also partly because the lower priced housing is not being sold. And that continues to be an issue there. So it gives you some slack in that sector of the economy. Other sectors, oil, food, remain very tight. Oil prices are rising. Food prices are very sticky. We're going into the summer month. That might help with some segments of food, but you have interruptions in Ukrainian and Russian exports of wheat and sunflower oil, cooking oil, and other factors that are going to keep food prices high. Other sectors away from oil and food, which are more volatile segments of the price index anyway, other sectors are mixed in their pricing. Next sector is finance. The Fed and other central banks are raising interest rates. They have the scope to raise interest rates significantly before killing the expansion. So there are people out there who are talking about how the Fed will raise interest rates and throw us into a recession. But there are a lot of other people who are saying, no, the Fed can raise interest rates and they can raise them significantly from where they are. They can raise them a whole nother % on the long end from where we are today and still be lower than we were at any point prior to the last decade. So we have scope for the Fed to raise interest rates, quell inflationary pressures, sterilize some of the inflationary things, liquidate some of their bond portfolio, reduce their balance sheet. We have the scope for them to do that without derailing the economic expansion. There are other factors that could combine with higher interest rates and compound that tightening and cause a recession. And I think the Fed is probably more cognizant about that than your typical YouTube guy talking about $10,000 gold. They're well aware that they don't control the economy, they don't control fiscal policy, they don't control oil market prices and food prices. They don't control prices in general. They have an influence, but there are many other factors that could compound that and cause them to have to pause from what they're doing. But they're pretty facile these days, the last 40 years, and they probably have a greater capacity to do that than ever before. It's funny because last week I think I talked about the statistical evidence that the economy is less volatile since 1947 with a national banking system than it was prior to the establishment of the Fed in 1914. And, you know, per what we would expect, there are certain people who say, let us ignore statistical reality and say, Jeff is wrong. And the economy is clearly more volatile than it was, despite what all the data says, and the Fed has been an abject failure. You cannot convince a true believer based on evidence, because that's heresy. Beliefs are not based on evidence. Beliefs are based on belief. And if you rely on evidence, you're not a believer. And then there are the guys who are marketing this stuff and trying to scare people into buying gold because it's going to $10,000, right? I mean, any day now for the last 40 years, 50 years. So you can't do that. So finance, yeah, it's an issue. We have to watch it. And then there's politics. There's the war. And as I've said in recent weeks, we are seeing a diminution of the war premium. That may pick up now with the EU's somewhat focus on oil exports and the ongoing prosecution of the war. It's hard to say, but we have seen the war premium reduce, and it probably will continue to remain present, but lower than it was in March and early April. The future role of Russia in the world, up for redefinition. It doesn't look good for Russia. It's very interesting. Foreign Affairs has several articles about what's going to happen after the war in the Ukraine. And we just have to wait and see. The US government has historically demonstrated a tremendous capacity to miss opportunities to make the world a better place. And there's every reason to believe that they can probably blow this one too. But the future role of Russia in the world is up for redefinition and doesn't look good for Russia, which probably means it looks good for everybody else. China continues to be an issue. There are a bunch of domestic issues as well as international issues. And again, it partly depends on how the U.S. plays its cards, whether or not how China plays its cards. It remains open to be seen. Domestic U.S. politics will be very important, and they're going to be nasty. And they're going to be characterized by an anti-intellectualism that is reminiscent of, well, the last 200 some odd years of U.S. history. So we should expect that. And then there are domestic politics elsewhere, really in a number of countries that are around the world. So you put that bouillabaisse together, you have economic slower growth, headed toward a recession at some point, but maybe not for a couple of years because there is some slack in the economy and things aren't as bad as the snake oil salesman will have you believe. And then you have oil prices and you have finance, rising interest rates, but will they rise enough to sterilize inflationary implications of past monetary largesse without throwing us into a recession? There is the scope that we could do that. There is the scope that you could do that. And there is some reason to believe that you could see economic expansion continue, not for the 2 more years that we're projecting, but maybe for even 4 years or longer, depending on how monetary policy, fiscal policy, and international politics all come together. So that's sort of the state of play. We're going into the summer. In the stock market, you sell in May and go away. And if you had sold in May and went away, you probably are pretty happy with yourself because you avoided some of this crunch that we've seen. Precious metals are sort of the same way, and we're seeing it, and we'll probably continue to see it. We will be launching our Platinum Group Metals Yearbook on June 28th. For those of you who feel that we neglect PGMs, you should plug into the online briefing on that day, because you'll see the best, most accurate, most honest, most unbiased data and analysis on platinum, palladium, and rhodium that you'll find anywhere in the world. Maybe only. We have put on hold our next CPM open forum for clients simply because we're so busy right now. We will be doing our silver online seminar. We had moved it from January 1st to January 8th. I have some things that have come up on January 8th, so I'm moving it to January 9th now, but we will be doing that in advance of the Prospectors and Developers Association of Canada annual convention, which comes in the 2nd or 3rd week of June. So that's all that we have for now. You can go to our website and download free reads, analyses, presentations, past videos. You can buy the gold and silver yearbooks from 2022, which are out and released. You can pre-order the PGM yearbook for this year. You can order last year's yearbook if you can't wait. And you can read all about the various services that we provide. Talk to you Friday. If you're in North America, stay cool, and we'll be around.